Welcome back to Introduction to Personal Financial Statements Part 2. We're going to pick up where we left off, the next slide being about balance sheets. Another type of financial sheet would be a balance sheet, which is a summary of your assets and your liabilities, and your net worth, which is your assets minus your liabilities. Your assets are what you own, your liabilities are what you owe, and your net worth is what you own minus what you owe, or your assets minus your liability. There are different type of assets. You have liquid assets. Liquid assets are easily available for use. I'd say money in a checking account, anything that's easily converted to cash to be utilized immediately. Household assets are items of value owned by a household. Cars, furniture, jewelry. The home itself is a household asset. They're not easily convertible to cash, but they still have value. They add to your overall wealth. Investments are also assets. Bonds and stocks and mutual funds and real estate are a number of investments that are part of your overall portfolio of what you own as assets. Here are a couple of streamlined definitions of each. A bond is a certificate issued by an institution to raise funds. You earn interest while you hold these bonds. Bonds typically issued in a number of $1,000. So let's say that you buy 10 bonds at $1,000 with 8% interest over the course of 10 years. That's pretty much how it works when you buy bonds. A stock is a certificate that gives you partial ownership of an institution. Corporations issue shares or stocks to shareholders so that they could in turn raise money for investments in new technologies or new management or new services, the like. Mutual funds is basically an institution that pulls together a bunch of different stocks or bonds and sells a package or shares to an individual. In real estate, whether it's commercial or domestic, you can make money by owning the home outright and selling the home, or rental properties, meaning you're bringing in residual income from the ownership of a second home that you at one point in time took out a second mortgage on or you bought outright. There are two types of liabilities: current liabilities and long-term liabilities. An example of a short-term or current liability would be credit cards or small personal loans of $1,000 that you anticipate paying back over the course of a year. While long-term liabilities are the debts that are going to typically take longer than a year to pay off. Mortgages, student loan, car loans, larger personal loans are, of course, examples of longer-term liabilities. This slide shows you an example of a personal balance sheet. At the top, you can see that you have your assets. Underneath your assets, you can see that it's broken down for your liabilities. You have secured loans, which would be something like a car payment or a mortgage. Unsecured loans, which would be anything like a store card from Macy's, Barnes and Noble, credit cards. Underneath that, you can see that you can find your net worth by subtracting your liabilities from your assets. And at the very bottom, which we're not really going to focus on now, we're going to focus on something a little bit different in later slides, something that says your degree of debt, which is basically subtracting your assets from your liabilities. And that number left over from that would be your degree of debt. In a later slide, what we're going to focus on is something called your debt to asset ratio, which is a little more familiar of a term that more people use. This slide focuses on your changes in your net worth, which are really easy to understand when you're utilizing a personal balance sheet. Here I've outlined 3 scenarios in which there is a change or no change in your net worth. The first example is if your income increases and all other expenses remain constant, your net worth will, of course, increase. In the second example, if your assets and your liabilities grow simultaneously at the exact same rate, your net worth will obviously remain the same. While if your liabilities grow at a faster pace than your assets, your net worth will actually decrease. Analyzing your balance sheet. Here's an equation called the liquidity ratio, which is your liquid assets divided by your current liabilities. Right down here we have a couple examples for you. This basically measures how well you can cover your short-term debts. Say for instance you're $15,000 in a savings account and you're $5,000 in debt, credit card debts, short-term current liabilities. Your liquid assets are $15,000 and your current liabilities $5,000. So your liquidity ratio would be 3. This means that for every $1 of debt that you have $3 in assets to cover it. A bad liquidity ratio would be anything less than 1. Really anything too close to 1 is not necessarily good. Meaning that for every $1 you have in liquid assets, you have $1 in debt. That means that you're, in essence, cancel out. Analyzing your balance sheet continued. Again, going back to that debt ratio. Here's the equation, the debt to asset ratio, which is your total liabilities divided by your total assets. This measures the percentage of debt to assets. The lower the percentage, the better, of course, in this particular situation. An example, you have $15,000 in total liabilities while you have $100,000 in assets. Your debt to asset ratio is about 15%. A bad example, you have $150,000 in total liabilities while your total assets are only $100,000. Your debt to asset ratio is about 150%, which is completely over leveraged. An interesting side note, if you're looking at credit utilization or your debt utilization when you're looking at credit reports, a lower number between 15 and 30% usually presents to creditors that you're very creditworthy, and most people that have credit scores of 720 and above are usually only utilizing their debts about 20 to 30%. Just a quick side note. The last equation that we're going to look at right now is the savings rate, which is your savings during a period divided by your disposable income during that period. The savings rate determines the percentage of money saved in accordance with your income or the amount of money you have available to spend or save. Currently, the U.S. average has shrunk to almost 1%, while debts have risen outrageously. A good savings rate depends on your ability to save, honestly, but a good place to start would be about 10% of your income. Financial statements are one of the easiest ways of tracking and forecasting how to increase your net worth over the short or near future. The next class that we're going to be focusing on is going to be called Time Value Concepts. Again, it's another financial planning tool that can be utilized to forecast your finances into the future. I hope this class was helpful for many of you. I look forward to seeing you all in the next class. Have a good evening.